We have the great honor to have Professor Richard Werner join us. There's a bit of a delay, but I think it's a natural part of life now with COVID, right? It's always a bit interesting to travel, but we're really happy that things worked out. I don't think he needs much introduction, but yeah, Professor Werner, has done so many things over the years. It would be impossible to say them all. He's a Shimomura fellow from the Japan Development Bank. He worked for many years in Tokyo. I think he even taught at the Jochi Dayak for a while. So it's quite a very good university in Japan. And now he teaches at De Montfort University in Leicester and Fudan Dashue in Shanghai, I think. So it's really quite an honor to have him on. So the Sora Economic Forum is really about sharing new and innovative ideas in economics and technology, and figuring out, how can we engineer a new economic system using, for example, technologies like blockchain. And that's some of the work that we're doing in Sora. And many of the ideas that we're implementing are actually based on Richard's theories and also empirical work, and also that of his students as well. So without further ado, Professor Werner, please feel free to introduce yourself and to start.
Well, it is a great pleasure to speak to you today, and thank you, Makoto, for this kind introduction, and also, most of all, thank you for your kind invitation to participate in this event, in which I believe, yes, cutting-edge developments in essentially currencies, financial markets, monetary economics are being discussed, and it's a pleasure to contribute, so thank you very much. Now, I would like to give a presentation, and this presentation is really about money and how money and the financial sector relates to the economy. And I shall use a PowerPoint. So I'm going to just pull it up shortly. Very good. Now, the general quantity theory is also known as the quantity theory of disaggregated credit, which sounds very specialized, but that is the general theory, the general quantity theory linking money and the economy, because it turns out that the one that's most widely used in economics, MV equals PY, which some of you may have heard before, that one is actually a specific quantity theory that only works sometimes under special circumstances. So that's a special theory, whereas the one I'm going to present is a general theory. Okay, what's on the agenda? I'm actually going to start with the economy before we move to money. And I'm going to ask, well, what is economic growth and what is needed for economic growth? And then what's often gone wrong with this process? There is this question, well, if there's identifiable problems that have often gone wrong, well, why haven't we changed things? Why have key decision makers not changed things? And what changes are these same decision makers now proposing today, and why? And so instead, what should we do instead in order to ensure what we all want? And I think we want sustainable, stable, equitable, non-inflationary growth without crises. Sounds too good to be true, but it can be achieved. And what can you do? Okay, so let's start. What is economic growth? Here's the bad news. There is no growth. And we know that from physics, namely the laws of thermodynamics. According to the laws of physics, there's only energy, which you can't create. You can only transform it. And as you do that, there is also the law of entropy. So, which means things are actually getting worse. But no, seriously, if you ask a physicist, explain economic growth to me, the physicist will explain to you there is no such thing. If we look at the physical reality, there is no growth. So then what economists talk about as economic growth is really a statistical illusion that we've created in national income accounting. And how did we do that? Well, study national income accounting. It's quite interesting. We've added up a certain number of select transactions that we've chosen, sometimes not quite rationally, but we've selected some transactions, we add them up. These transactions are connected to goods and services, but we're not subtracting certain costs that are imposed on society and the economy as a result, such as the depletion of the stock of natural resources and entropy. Now, this statistical illusion, creating economic growth, so growth as statistical illusion concept, that was really created by large banks over a century ago in order to find out how much interest can they charge governments when lending to them. Because, of course, that was done via government bonds being issued by countries and those lenders, big lenders in those days, purchasing them and lending to the governments. And their question was, well, we'd like to charge high interest rates, but they realized we mustn't overdo it. So what's the maximum interest rate we can charge without blowing up the host? You know, the parasite needs to keep the host alive. And of course, the maximum you can charge is the economic growth rate. And that's how economic growth comes about. So really, economic growth is a measure of, and by the way, that's if you haven't seen the data, that's why long-term interest rates follow nominal GDP growth, because that's maxing out on what you can charge governments on their bonds. And so this is really how economic growth came about. It was reverse engineered as the bankers wanted to know what is the maximum we can squeeze out of this bunch of people here in this country. And that explains why nominal 10-year bond yields, i.e. long-term interest rates, follow nominal GDP growth and usually very similar, if not identical in size. Okay, and just on this empirical issue, if you want to look at the data that's on the UK, that's on the US, the link between nominal GDP growth and nominal interest rates. If the big banks charge the government much more interest than the nominal GDP growth rate, a debt trap would follow because interest, if interest is larger than economic growth, you will forever get into debt and you can't ever get out of it. That's, of course, what's being done to developing countries in order to, this is a form of predatory lending, in order to seize their resources as they get so over indebted. There's no other way out, they're being told, than to flog their assets cheaply or hand them over to the foreign creditors. So back to the issue, what's economic growth? Oh, it's actually a nominal concept and a monetary concept, since it goes back to transactions taking place in markets and paid for with money. And money is a nominal and monetary tool and concept. Now, here's another fact of national income accounting you need to be aware of, and many people are not aware of it. Financial transactions, and in general, more generally speaking, asset purchase transactions are not part of GDP because GDP tries to measure value added, as we just discussed, in the attempt to find out what's the maximum you can squeeze out of the economy. Financial transactions are simply purchases or sales of assets between counterparties, merely transferring ownership. They don't add value. They're zero-sum game. While one person gains, another person has a loss of equal size. By contrast, activity that produces new goods and services, entrepreneurship resulting in the implementation of new technologies or increased productivity, is a positive sum game. Value is added, everyone's better off in total, and society benefits. Economic growth means that those transactions that are part of GDP have increased this year compared to last year. Now, how is that possible? How can we have more transactions taking place this year than last year, which means economic growth? What is needed for that? Well, what's needed is that more money has been used to pay for these transactions. And that's how we get our first link between monetary things and the economy. So this equation here, delta being change. So the change in P times Q is the price times the volume, the quantity of transactions. Therefore, on the left side, PQ is the value of transactions. So the change in the value of transactions is equal to the change in the money used to pay for these transactions, which traditionally is written as M times V, the money supply times the velocity. Well, just think of it as effective money used for these transactions. Now, how can we have, therefore, an increase in the value of transactions? It's only possible if we have an increase in money used for these transactions. How can we increase the money that's used for transactions? Well, this can be done if we inject more new money that is used for transactions. And how does that happen? Because we're talking here about an increase in the money supply. In order to understand how we can increase the money supply, we need to understand, where does money come from? And before we answer this question, we need to quickly look at some fundamentals in economics, because what I've been talking to you so far about is really economics. And you need to understand there are two approaches in economics. Mainstream economics is the one that's taught at universities, that textbooks are about, that central bankers are always talking about. And this mainstream economics really was started 250 years ago in England. It's still dominant globally in the English language mostly, but also in other countries in Europe and across the world as the dominant economics. And this economics is actually equilibrium economics. It's all about equilibrium, demand equals supply. Now, how do we get this equilibrium? Well, prices move to give us equilibrium. But you have to read the small print, because actually, even though all economics, modern mainstream economics assumes equilibrium, we only get equilibrium if and only if a long list of assumption holds. And here they are. Perfect information, complete markets, perfect competition, instantaneous price adjustment, zero transaction costs, no time constraints, profit maximization of rational agents, and people cannot be influenced by the actions of others, and people don't care about others. Wow, that's quite a description of a strange world on a strange planet. That's quite different from life on planet Earth, I believe. But anyway, if these assumptions hold, then prices move to equilibrate demand and supply. Does any one of you recognize this picture? It's a drawing from a children's book in England. And in fact, this is little Alice in Wonderland. And here she's being drawn by the Queen, pulling her along as they fly through Wonderland. There's a quote from the book, Alice in Wonderland by Lewis Carroll. Alice laughed. "There's no use trying," she said. "One cannot believe impossible things." The Queen responds, "I dare say you haven't had much practice. When I was your age, I always did it, that is, believe impossible things, for half an hour a day. Why, sometimes I've believed as many as 6 impossible things before breakfast." But what we learn here is that Alice in Wonderland will be no good as an economist. But we also learn that even the Queen in Wonderland, who's much better at believing impossible things, could not possibly work as modern-day economist, because it is clearly insufficient to believe in 6 impossible things before breakfast. Nay, as an economist, you have to believe at least 8 impossible things, and not just before breakfast, but all of the time. Let's give it a good shot, though. Let's assume that these assumptions are more likely to be true than not, which I think is nonsense, but let's just humor those economists. Let's say that the probability of each assumption being true is more than 50%, say 55%. I know we are being very generous. We're really humoring those economists, but let's try that. My question is, economists pride themselves in using mathematics, have they really thought the mathematics through? Because even if we put the probability of each assumption being true at this extremely high and unlikely percentage of 55%, what is the probability of getting equilibrium? Which is to say, what is the probability of all 8 assumptions holding at the same time? And of course, you guys are much smarter than me. You know, the calculation is 0.55 to the power of 8, because it's a conditional probability, a joint probability. You have to multiply each probability. That means 0.55 multiplied by itself 8 times, so to the power of 8. And what is that? Well, I'm afraid it's not a very large number. It turns out to be less than 1%. Yes, you heard right. So even if each assumption has a high probability of being true, say 55%, the joint probability of all of them holding at the same time is less than 1%. In other words, highly unlikely. But we know that each assumption doesn't have a probability of 55%. It's more like 0 for each one. In other words, what we learn from this is that textbook economics is a fairy tale far taller than Lewis Carroll could have made up. It's a fairy tale that is beyond what Alice in Wonderland and the Queen in Wonderland might have imagined. Therefore, we know we can never expect equilibrium. Markets just don't clear. Equilibrium is a fairy tale. In reality, markets are rationed. Now, how come this theoretical approach of fairy tales is so dominant? This is called, in terms of its methodology, the hypothetico-axiomatic approach. Well, the reason is that this suited those that wanted to confuse people about reality and obscure reality. They developed what is called modern economics, and it is very nice propaganda, and it certainly has succeeded in confusing a lot of people. So this modern day English language economics is equilibrium economics, and that is nonsense because there is no equilibrium. In reality, we cannot expect markets to clear. In fact, all markets are rationed. All markets are in disequilibrium. Demand does not equal supply. Information, time, and money are rationed. All markets are rationed. Now, how do ration markets work? They're determined by quantities, not prices. And there is one simple rule, the short side principle, which says whichever quantity of demand or supply is smaller determines the outcome. Now, there's one more thing to this, which we don't have time to discuss, but the short side has power, and power matters. Power is like money. Power is perhaps even more important than money. The short side has the power to pick and choose with who to trade, with who to do a deal, and who's going to get business. And that's happening in every market. This power is being exerted and, of course, mostly abused. Just think of how the market for hiring actors in Hollywood works, and how those who are on the short side, namely the producers deciding who's going to be the actor or actress, how they make their decision and the sort of things they extract in benefits, if you want to use such words in this context, in order to make the decision. Now, government intervention is said to be highly inefficient in standard economics because they compare this to the perfect dream world in their fictional models. Their government intervention can only be a distortion and inefficient. But that's true in the theoretical Alice in Wonderland world of general equilibrium, where markets are so perfect. Once we adopt a different methodology, not the deductive, but the inductive, and that is the scientific research methodology, where we first seek facts and then develop testable theories. In other words, once we seek truth from facts, as Deng Xiaoping put it, who's pictured here, and we therefore recognize that all markets are always rationed, we see that government intervention can quite easily improve market outcomes, because in reality, market outcomes are not optimal. markets aren't even in equilibrium. So the hurdle for government intervention to improve market outcomes is much lower than thought. Now, with this preamble, let's go straight into banking. Here's an excursion into the mysterious world of banking. Did you know that until I published a paper on this a few years ago, there were essentially three theories of banking, and the experts couldn't agree on which one was right: the financial intermediation theory, the fractional reserve theory, and the credit creation theory of banking. Now, which one is correct? Well, the scientific thing to do is to conduct empirical research and test the three theories and find which one is correct. Of course, that is very far from the thoughts and minds of economists who prefer the hypothetical axiomatic approach, where they simply assume their preferred results to be true by definition, and therefore they continue to live in their ivory tower and had not conducted the necessary scientific experiment in order to scientifically establish how banking actually works, until I then did the job. And just to explain briefly the three theories, the financial intermediation theory says banks are intermediaries. They gather deposits, the savings, then select who to lend to. The fractional reserve theory emphasizes the fact that in many countries, banks give a reserve requirement, place it in the central bank, but each individual bank is an intermediary, also in the fractional reserve theory, except in aggregate, somehow, collectively, the banking system creates money, says the fractional reserve theory, which otherwise is slightly complicated. And there's a third theory which says, no, banks are not financial intermediaries. Banks are creators of the money supply, and they individually create money when they lend. Look at these three theories. The financial intermediation theory is the currently dominant one, has been dominant since roughly the 1960s, and it says that banks don't create money individually, they don't create money collectively. The corresponding bank regulation is the Basel capital adequacy approach. Before then, from the 20s to the 60s roughly, the fractional reserve theory was dominant, which says that when a bank lends, the money comes from reserves at the central bank, excess reserves, and banks don't create money individually, but somehow in the system, money is created. The corresponding regulatory approach is the reserve requirement condition for banks. Thirdly, there's the oldest theory called the credit creation theory of banking, dominant until about the 1920s. And that one says the source of money when a bank lends is nowhere, nothing. The money is just invented like fairy dust. And banks, no, they're not financial intermediaries. They create money collectively and individually. The corresponding bank regulation is credit guidance or credit controls, guidance of bank credit. Now, I conducted the first empirical tests of these three theories, and just to give you the conclusion, in case you haven't been aware, but many of you will have been aware, the financial intermediation theory is wrong and was rejected. The fractional reserve theory is wrong and was also rejected. But the credit creation theory is correct. Banks create money when they lend. And, oh, by the way, that's how our entire money supply comes about. Now, if you look at the law, then you very quickly understand banking. While economists claim that banks are deposit-taking firms that lend money, at law, it's very clear banks don't take deposits and banks don't lend money. Really? Banks don't take deposits? No, they don't. Instead, banks borrow money. They borrow money because deposits don't exist at law. And what really happens when you do what is called a deposit is you're lending money to the bank. And therefore, you don't own the money anymore that you deposit, in inverted commas, at the bank. It's owned by the bank. So the depositor lends money to the bank, becomes a general creditor, and the bank records a credit on behalf of the customer in the record of its debts. So that's why banks don't take deposits. They borrow from the public. And banks don't lend money either, which is different from other firms such as non-bank financial institutions, insurance companies, and so on. Instead, banks are in the business of purchasing securities. Why? Because the loan contract is a promissory note that the bank purchases, and then you get the money. No, the bank actually doesn't pay out the money it owes to you. It simply records the money it owes you. And the record of its debt to the public, how much it's borrowed from the public, is called bank deposits. And that's what we use as money. This is how the money supply is created, invented. When a bank lends money, it creates new money. So we can show this in balance sheets and banks in 2 steps. First, the banks purchase the loan contract, and then it credits the borrower's account at the bank with the amount of the money that the bank is supposed to lend to the customer, when actually it's simply a record of the money that the bank has not paid to the customer and still owes, because the bank rebooks what is actually an accounts payable liability arising from the loan contract as another type of liability called customer deposit, which is technically speaking illegal, but let's not worry too much about such details. So when you get a loan from the bank, you borrow money from the bank, no money is transferred to your account from anywhere in the world, not inside, not outside the bank. The money is newly invented by the bank. So banks create money. They're not financial intermediaries. It's just one of many examples where the truth is the opposite of what the textbooks in economics tell you. So banks are special. They create the money supply. This process is called credit creation. That's why the credit creation theory of banking uses this concept. And it gives us a unique measure of the money supply. But we also can and should disaggregate bank credit creation by its use. Because when new money is created, it will always have an impact on the economy. It will affect everyone. But how will it affect everyone? This impact varies depending on how the money is being used and what the money is being used for. The decision of how much money to create and who to give it to for what purpose is a key decision that will reshape the economic landscape. This decision is made by banks because they create the money supply when they do what is called bank lending. That's why central banks often feel very tempted to intervene and guide bank credit. We can formalize this in the quantity theory of disaggregated credit, also known as the general quantity theory, where we define money as C, credit, and then we look at credit creation, the change in C, and this is new money creation through bank credit extension. And here it's important to separate it into 2 streams: credit for the financial markets, asset purchase transactions, what I call C subscript F, that determines asset markets, and credit for the real economy, C subscript R, which determines, of course, nominal GDP growth. If banks create credit and allocate it for non-GDP transactions, that is CF, financial transactions, we get asset inflation, and if large enough, which usually is the case, banking crises and inequality. But if banks create credit and allocate it for real economy transactions, we have 2 further possibilities. If it's used for consumption, you get consumer price inflation. That's the specific theory called MV equals PY, which is just one specific special case, not a general theory. And thirdly, and in fact, this is the redeeming feature of banking, when banks create credit for productive purposes to implement new technologies or enhance productivity, the result will be growth without inflation. And also banking will be stable because there are income streams to service and repay the loans, which is not the case for either consumption or asset purchase credit. So here we've got the 3 scenarios. 2 of them show unproductive, unsustainable credit creation, namely credit creation for consumption and credit creation for asset purchases, resulting in problems. But credit creation for business investment, for the real economy, for productive business investment, will create growth without inflation, even at full employment, which means there is almost no limit to growth. We can have very high economic growth. Because remember, there is no growth, it's a statistical illusion, and surely we can expand the numbers. That is productive credit creation. By making sure that bank credit is used only for the green box, you get very high economic growth. That's how in Japan, Korea, Taiwan, and China, decades of high double-digit economic growth was achieved. You essentially block out these unproductive, unsustainable forms of bank credit creation, and you make sure that it's mostly sustainable, productive credit creation what banks are lending. That can be tested and shown in detail in econometric models, also here in eye inspection, looking at Japanese data where bank credit causes and determines GDP growth and statistically shown, and credit for asset purchases determines, for example, the property markets, real estate prices. When we get an increase in CF, credit creation for asset purchases, then you get a scenario of asset inflation. And in Japan in the 1980s, when the biggest asset bubble in history was created, the percentage of credit that's for asset purchases doubled from 15 to 30%, while total credit, of course, also expanded dramatically. That was the asset bubble. You see here in this graph, credit creation growing much faster than nominal GDP, excess credit creation into asset markets, causing a bubble and then a banking crisis. The same thing, of course, happened in Ireland, Portugal, Spain, and Greece from 2005 roughly onwards, when the ECB encouraged banks to create credit for asset purchases, property booms that result in busts and banking crises as usual. Now, why have the key decision makers not changed things? Because we seem to be getting recurring banking crises, asset inflation. Now asset prices are very high in many countries and actually likely to rise even further, which will for sure create a huge financial crash in the future. So why are we just repeating the same cycles and stories again? The revealed preference of the decision makers is that this is what they want. In the theory of bureaucracy, you consider bureaucrats and their bureaucracies as essentially people who, like everyone, want to increase their influence, and that means their power, and therefore they seek to expand their control over the economy. We should apply this to central banks. They have in their hands the levers to control bank credit creation and therefore the entire economy. Over the past half century, central banks have become more powerful than ever before in history. This time period coincides with an increase in the amplitude and frequency of business cycles. In fact, we can't really talk about business cycles anymore. They're boom-bust cycles. That's the revealed preference of the central banks, who have full power and control over the past 40 to 50 years, where they've become independent and largely unaccountable for their sometimes surprising actions. I called this central bank risk in 2003 and gave dozens of presentations about how the increased power we've given to central banks is likely to result in bigger cycles, boom-bust cycles, and banking crises. Because each crisis has resulted in more powers being given to the central planners at the central banks, they actually have an interest in creating another crisis. So I call this regulatory moral hazard, because the central planners get rewarded for each crisis they create. Now, what changes have these same decision makers been proposing? They say, oh, Professor Werner has made a study and pointed out that banks create credit. So we did a bit of a check recently and we found it's true. Banks create money when they create credit. Wow. Well, therefore, we quickly have to abolish this. So they now announce as Plan B, now that the knowledge of bank credit creation and money creation is spreading globally like a bushfire, that this power of banks should be taken away. Obviously, this is in order to prevent the general public from seizing that power and using it for public benefit. So the goal is to abolish banks and concentrate all money creation in the hands of the central planners at the Soviet-style mono-central banks that want to be the only banks in town. That explains why over the last 20 plus years, central banks have used monetary and regulatory intervention to reduce the profitability of ordinary and particularly small banks, driving them out of business. The ECB has already killed 5,000 banks in Europe. And now central banks, who are bank regulators, argue that they're allowed to directly compete with the regulated. So the regulator is stepping into the arena and competes with the regulated, the banks, by offering alternative, competing services, namely current accounts. Of course, they don't want this to be so obvious, so they don't call it current accounts, they call it CBDC, central bank digital currencies. This means that if it's organized in the way that is proposed in Europe and America, banks will be driven out of business and will disappear. And the next banking crisis is likely to precipitate that process, finishing off the banks and ushering in the era of only one bank, the central bank, existing in a Soviet-style economy. There's some side effects. Once you've done that, you realize there's no economic growth. Oh, that's interesting. Central bankers are now talking about the green agenda and how we should degrowth. Well, once you've killed the banks, that's what you're going to get. But of course, it's not true to claim that growth is harmful for the environment. Environmental destruction is harmful for the environment. It's like saying a knife is dangerous, we should abolish all knives. Well, economic growth per se is not dangerous. It is pollution and environmental degradation that is the problem. And we can have that at zero growth. Do you think we have zero growth and then there's not going to be any pollution of the environment? No, that's not how it works. So you've actually been deceived. It's not economic growth that's the problem. It is the harmful activities that needs to be reduced, and that has nothing to do with economic growth. Instead, by focusing on green economic activity, you can actually increase economic growth significantly. Central banks have also abolished the have proposed the abolition of cash, which is an alternative to central bank digital currency. And they've also proposed and supported the idea there should be universal basic income because there could be large-scale unemployment. Of course, that's been happening since 2020 when governments killed entire industrial sectors, catering, hotels, and so on, restaurants. And once you have large-scale unemployment, then you can use universal basic income as the bribe to accept the chip implant with the central bank digital currency in it. Of course, by having such a system with only the Soviet central bank in the game, you will perpetuate the problem of the excessive power of the central planners. And also the central planners will be more powerful than ever before in history. It's a totalitarian scenario. And the unprecedented restrictions of civil liberties that have been imposed in most countries in 2020 are an indication of the type of new normal that the central planners have been having in mind. Now, what should we do instead of following the central planners' agenda? We want to achieve sustainable, stable, equitable, and non-inflationary growth without crises. I pose that the question is not banks versus central banks. It is centralization versus decentralization of decisions. Should the allocation of the money supply be done by central planners or be organized in a decentralized market-based fashion? What is the scientific way to tackle this problem? We should, of course, consider the empirical evidence, which means the historical track record. So what's the evidence? Centralized decision-making, Soviet Union. That didn't really go very well. It collapsed in the 1980s. By contrast, China decided in 1982 to drop the Soviet model and create thousands of commercial banks, rather like the US. And we know the US is not a Soviet-style economy. So the result was China thrived and delivered what many people have called an economic miracle, double-digit growth for several decades, multiplying national income. They used also window guidance bank credit guidance in order to suppress harmful bank credit creation and encourage productive credit creation. So that's the empirical evidence on centralized decision-making. It doesn't work. Soviet Union collapsed. China went the other way, the opposite way, for decentralized finance through founding thousands of banks. That worked very well. What about the ECB? Well, it's a very centralized central planning institution, and it created the huge property bubbles, banking crisis in Ireland, Portugal, Spain, and Greece. So it's not a really good example, or it's a good example of the failures of central planners having too much power. Other evidence on decentralized decision making is from the US and Germany. Let's just look at Germany for a moment. German small firms are doing very well internationally. They are at the center of 200 years of strong German economic performance. Many German small and medium-sized enterprises are world market leaders in many industries, and exports from Germany have been almost as large as Chinese exports. Although, of course, the German population is a fraction of China. Now, you can look at SMEs, small medium-sized enterprises, that are very successful. And if we look at those that have global market share, number 1, number 2, or number 3 positions, so they're top champions, gold, silver, bronze champions in their markets, then Germany has most such market leaders. They're called hidden champions because they're champions, but they're hidden because they're SMEs that, they're not big brand names. Nobody knows these names. So hidden champions. Germany has the largest number of such hidden champions. And that's because, so their SMEs, German SMEs are so super effective and successful. And that's because Germany also has the largest number of not-for-profit or public community banks, 1,500. 70% of deposits are with community banks, 80% of banks are community banks, and over 90% of SME lending is done by these community banks. They were not affected by the 2008 crisis. In fact, people shifted their money from other banks to these community banks because they knew they're safe and sound. No tax money has ever been used to bail them out. No depositor has ever lost any money. So in Germany, there was no recession and no increase in unemployment in 2008. Because why? Well, here's the result. Here's the answer to the question. This chart shows the number of banks in each EU country. One sticks out like a sore thumb. That is, of course, Germany, where we have the largest number of banks in Europe. And what we find when we study the relationship between the size of banks and the size of their lending and the size of their customers, there is a very clear pattern that big banks want to do big deals, lending to big companies. Medium-sized banks lend to medium-sized customers, but small banks are the only ones lending to small firms systematically, or to put it differently, the propensity to lend to small firms is larger in small banks. And therefore, we need to create small banks because the largest employer in every economy, whether US, Japan, Europe, is the small firm sector. And here we have measured by deposits, the German banking sector split into the different types of banks. And the two green segments are the not-for-profit community banks. Put them together, 70% of banking by deposits is not-for-profit community banking. So how should we reform the system? Some people say, let's abolish bank credit creation and centralize the powers to create money in the hands of the central bank. That's centralized decision-making structure, giving central planners even more power, but they have not been successful. It's clear that it's better to make bank behavior transparent, accountable, sustainable, by restricting bank credit creation for transactions that don't contribute to GDP, asset purchases, and create a network of many small community banks lending for productive purposes, returning all gains to the community, creating real choice in banking. And therefore, it's better to decentralize the money creation structure. We need decentralized finance. So that's what I've been working on for the past decade, establishing not-for-profit community banks. There's been quite a bit of resistance, but we're getting there. So the Hampshire Community Bank is due to launch towards the end of this year, based on the German model, and there's others in the pipeline. The promises of economics, my last slide, or last but one slide. Until the 70s, economists particularly, have been very optimistic, and they thought that, well, with proper economics, we can solve most problems in the world. And there was this very strong optimistic mood. Was this reasonable? Were people too optimistic? Well, I think it was reasonable. I'm with JFK, who said, our problems are man-made. Therefore, they may be solved by man. and man can be as big as he wants. No problem if human destiny is beyond human beings. Thank you very much. There's New Paradigm in Macroeconomics, Palgrave Macmillan, and I also recommend Princes of the Yen, the edition that's available from quantumpublishers.com, because that one has the long lost last chapter that's not in the first edition. Thank you very much. That was the presentation. I'm going to stop sharing now, and we can have a few questions. I will shortly have to run, but let's just have a few questions. Thank you. Over to Makoto.
Yeah, thanks, Professor Werner. It was quite interesting presentation and very easy to understand. So thanks for, I know today has been a very hectic day for you, so thanks for making it work. Yeah, there's so many questions. I'm not sure where to start. I'll start with El Salvador. So El Salvador recently has gone from one foreign currency, which was the US dollar, to saying that we want to use another foreign currency, which is Bitcoin. Do you think that there's any fundamental difference between the dollar and Bitcoin that would help El Salvador to be, more successful than what they would have just keeping the dollar?
Yes, it's an interesting question. Of course, Bitcoin is very different from the US dollar, but as you correctly point out, it does have certain things in common with the US dollar from the perspective of El Salvador. It is a foreign currency, and it's one that El Salvador has no control of. And that is, of course, already the key limitation. That was the limitation of having the US dollar, and that would then also be a limitation using Bitcoin. Therefore, I mean, if you do it as a sort of PR stunt in order to get the attention of the world, and if you then use it for a clever currency strategy, I think it's probably not a bad idea. But if you actually do want to rely now only on Bitcoin, you probably realize after a few years the limitations. It is better to design a new coin. Why not have El Salvador coin, which is to say your own national currency? And then you also need to think about the decentralized structure, which is superior to a centralized structure. And particularly when countries like El Salvador that have been having a foreign currency often say that this is good because it ties down our hands. Politicians can't just switch on the printing presses because we're using a foreign currency. Well, if you have those worries, well, that's a very good reason of taking away that power from the central planners and decentralizing and saying, okay, well, let's rather have some professional trained bankers in small community banks, which is to say experts in analyzing small businesses and micro businesses and selecting the ones that will service and repay loans. And let's have thousands of them in hundreds of banks, and there are hundreds of bank branches on the ground, kicking tires, going around the country. Do you think these thousands and thousands of professional SME experts together collectively will produce a better result than one central planner at a central bank or in a government controlling a national currency? I think they will do better. And therefore, we have to think about structures that will allow such decentralized money creation and also linking money creation to productive purposes. SME lending in particular tends to be very productive.
You kind of hinted that the global trend seems to be towards getting rid of smaller banks and instead centralizing authority in larger banks or even in central banks through CBDCs. But at the same time, you're busy setting up banks like in the UK that follow the Sparkasse model. So I'm wondering, do you think it would make sense to set up a bank in today's ecosystem? Like, are banks going to go away? Is everyone just going to get money directly from the government?
I think that's, you recognize these trends correctly. We have trends that are against banking. There is the trend that I mentioned towards universal basic income, government payments, stimmy checks, and things like that, all accelerated by the policies taken under the guise of a virus. Yes, So why set up community banks? Because they have the support of the community. That is their strength, and that's why also they are likely to succeed in reversing this trend that we're currently seeing. So there is this worrying trend. It goes against banks. The big banks will not get public support, and the public will be quite happy to see those go. But small banks that are community linked will gain public support. And with that public support, it will be possible to ensure that there will be a regulatory environment that allows their survival in the future, even under these adverse conditions. And that's all we need. And also people need to realize we're talking about small local banks that essentially do no harm. They don't cause banking crises. They don't cause economic upheaval. They're non-systemic, but they do a lot of good and make ordinary people much better off. So there's essentially no downside. And the guys who talk about centralizing, well, as long as we agree to carve out a niche for the community banks, then maybe they can go on doing their centralization bit. There will be enough left for the general public to benefit and for the economy, therefore, to do well. And I think the resulting public support is what's going to carry the day in support of community banks.
Unfortunately, it gets harder and harder for smaller banks, especially with the Basel Accords. So I have a friend who works at a bank in Japan, and they have almost infinite ability to create credit if they wanted to, but they can't actually create any credit for small businesses because there's no Moody's rating for small business. They don't know how to handle the risk model, and this gives it the highest risk rating in the Basel structure. So they're not able to lend. So it really seems that the entire tide is really against this kind of fiat-based banking system. And one question I really wanted you to answer today is, where do you see the fiat system going? Are we in a transitory state where we could see something like a cryptocurrency surpassing, the dollar or supplanting the dollar, or are we going to see like just a different fiat currency, or maybe even the SDR taking over the dollar's place?
Well, I think at the moment it's an exciting moment in time. Many things are up for grabs. It is possible to push for innovations and changes. There is a number of people and powerful institutions pushing for central bank digital currencies and then a globally linked system of such central bank digital currencies. But at the same time, it is possible, I think, in these years to establish alternatives. And if they gain enough public support, then there should be enough leeway to change or to preserve the regulatory environment to ensure their future. So I think nothing is written in stone. We can change things, and that's why we all have to be active. And that's why your work is very good, Makoto, because you're very active in this space. People need to engage. They need to realize their options. Things are changing. We can make new proposals. We can push for alternative systems, and we need to figure out what is best. Just accepting what is being proposed by the central planners is not likely to be the best option.
Yeah, it's really, I think the world is really at a turning point, and I think it naturally would have come anyway, but I think what happened with COVID and the lockdowns and everything have really accelerated a lot of these trends. And I know you had trouble today because of these artificial restrictions, which is quite funny because people under 60 don't have any statistically significant increased risk of dying from this disease. But it really felt from 2020 that it was a year of, in many ways, science died more than people from the pandemic. Which there's a great human tragedy as well, but it's really the trends are really anti-intellectual, which are quite frustrating, I would say, because we won't be able to reach our full potential as a species if we don't, I think, use use our intellect and creativity to the extent that is possible. So, I mean, I have an infinite number of questions. I'll just say that we had a speaker earlier today, Nikita Gurin. You might remember him. He was at the
Yes.
at your talk in your class in Oxford 2019. I was wondering, are you going to have this class this year?
I'm not quite sure. I mean, it is getting late this year to do it, to pull it off, but it's still possible because, of course, the format is going to be online, and so we may try, but we'll definitely have it next year. So this year is not quite decided. It's been such a busy year, but yeah, thank you very much for also reminding me of some of the participants. It's been always great and very stimulating.
Yeah, it was really quite a very intellectually inspiring time with me, and I really enjoyed your books as well. Like New Paradigm in Macroeconomics is one of the easiest, I think, to understand. But I hope you can publish some more books in the future. So yeah, I really appreciate you coming on today. I'll just ask one more question, and that's people had wanted to know about the link between your theories and Sora. I explained this a little bit in my talk this morning, but really what we're trying to do is provide a way that a blockchain-based currency can be kind of a supranational currency, and it can be minted from according to a smart contract. But at the same time, countries like El Salvador don't have to treat it like a foreign currency. They can actually participate in the decentralized democratic allocation process. So what that means is and our next speaker will talk about this, Turiel Berishis, about using a multi-body sortition process to make it so that anyone can make a proposal to allocate money, and then there's a kind of a proposal pipeline that goes through. And what we're hoping to do is actually scale this so that it goes with your vision where local decision makers can make decisions locally. So that's where you would bring in the local expert knowledge. But I was wondering if you had any, beyond that, if you had any additional thoughts on, because you didn't talk much about cryptocurrency today. I was wondering if you had any change of heart since we last talked, where you were quite negative on cryptocurrencies, but maybe you...
Well, that's for the long run. In the short run, or the medium run even, I think, yes, there is a contribution made by cryptocurrencies and alternative currencies, and that is likely to be quite visible in the coming few years. In the long run, I am sort of negative because I just see that there's a high likelihood that it will be shut down at some stage by regulators. But as I said, nothing's written in stone. And so with that in mind, there is a good chance that we could perhaps avoid that scenario.
Yeah, there's a lot of risks. To be honest, yeah, the world is quite an unpredictable place now. But I really appreciate you making the time. I know today was probably a bit stressful for you with traveling and all the things that happened. But yeah, thanks for making the time, and please keep in touch. So have a good day.
Great. Excellent. Thanks for having me, and let's speak sometime soon. God bless. Bye-bye.